Welcome back, guys, to our history of banking in the United States today as we continue where we left off last class using our Chapter 10 Money and Banking notes. Last class, we were working hard to develop a modern idea of what currency is and what it does for our contemporary society today. So we talked about things like commodity money, representative money, and what we're on right now, fiat money. So this basically follows the same arc of history and showing you how a modern banking system has emerged in the United States. The video that you see here on your left is a history of central banking in the US, and it parallels what I'm going to show you here in the notes. For that video, you're expected to watch. It's very short, 25 minutes. And you'll be taking notes on the different parts of that kind of go along with the history of banking in your textbook chapter. I'm going to hit and follow up on those notes here. So you'll see some things that you might be able to add to your notes before you submit on Canvas for a grade. Essentially, if I show you the PowerPoint here, you're going to see it's a walk back through the history of the United States. Early views of banking basically followed politically what we were going through at the time, where you had a group of people who were really into a strong central authority that would tie the colonies and then the states together. But others who resisted that, having just fought a war against the British Crown. Central authority was not something many states' rights thinkers were into. So they basically had the same thing affect our economy from early on. Now, Hamilton's in charge of the Federalists, who said that there needed to be a central authority that would run the nation's banking account and collect taxes from the people. There also needed to be the idea that this would control monetary policy moving forward. But the Anti-Federalists, that was too much for them because they'd just fought the revolution to get out from under that. So Jefferson's the leader for the Anti-Federalists, and he would argue that states have the right to print currency and run local affairs as they saw fit. Now, two things emerge from that very, very early history. Number one, even today, we have a dual banking system where you can have a state bank or a nationally chartered bank, depending on where the bank chooses to do interest. You have large, big banks like Citibank or Citicorp or Chase, JP Morgan Chase, and they pretty much operate in all the 50 states and even abroad. Some states here locally only have a charter for state operations or for a regional state system. So you can choose to go big or go small, depending on what your particular outlook is. The second thing that kind of is a holdover from this is that we have a battle over the 19th century for whether or not to have a United States bank. We'll have the first Bank of the United States, and its charter will expire. We'll have the second Bank of the United States, and its charter will expire, creating this whole free banking era, which sounds like a great idea, free banking, right? But it means that it's basically unregulated. And it's very, very difficult during that time to know or to develop trust in a banker who has just opened his doors for business in the town. It's completely unregulated, and you have no idea what those dollars are worth. So it kind of thwarted the ability to create a national banking and currency system. And that's really what you got to have in order to have a modern economy. So this is kind of how that played out. By 1860, the date of the beginning of the Civil War, we had 8,000 different currencies floating around the U.S. Some were strong, some were not worth the paper they were printed on, and you had to figure out on your own which to trust in. So you can imagine people were, they were just shanghaied left and right and turned over their valuable wealth in the form of gold and silver to bankers who gave them, worthless pieces of paper. Ultimately, that means, too, that even in the banks that had strong currencies that were trustworthy, you could count on bank runs where people rushed in to get their currency out based on a panic kind of mentality. So you could have a bank that was doing great one day and turn around the next day and all of its deposits were gone. You also had wildcat banks who took advantage of the lack of infrastructure and moved into rural and unpopulated areas, promising to modernize and bring the latest innovations in currency and banking to people who had no access to the banking system. They would have people bring in their valuables that would be locked up and monetized. People would be issued slips of paper, and then the bank would pull out of town unexpectedly. And there was really no regulatory agency to prevent them from doing that. But that really hurts our trust in banking. I mean, if we're still having difficulty trusting in a currency, you can imagine how destabilizing this is. And then accounting fraud was a huge problem. Nobody was overseeing the books. So bankers could invest in all kinds of risky schemes with depositors' money. And it just created a very unstable banking system and nothing like a national system of currency. So that began to change right about the time of the Civil War, and policies that were adopted in the North eventually, of course, were adopted in the South. But greenbacks were issued to fund the Civil War. That's basically the nickname that's given to the currency, which had green ink on the back and black ink on the front, a tradition that we still use in our currency today. The idea was that you could still have your state bank currencies if you wanted to, but you would be charged a 15% penalty tax for consistently using those currencies. So eventually people just converted to the greenback, and that became our national currency. After that was done, then it was decided that we needed a banking system that was also national. 1873, we get the NBS, and that established control basically over printing to stop the overprinting of currency and create what basically is our first monetary policy system. So many banks in Texas, if you go to a West Texas town and you see a bank called First National, highly likely that it's been there since 1873, because that was kind of a sign of distinction. You were the first bank locally to associate with the national banking system, and that gave your customers, your depositors, a little bit more trust. They knew that government agents would at some point be checking out what you were doing, and that you would be held accountable by U.S. law. Another innovation at the time, people were much more comfortable with notes that were backed up by physical lots of gold and silver. So the government began to issue, alongside the greenback, treasury certificates, which is a form of representative money. You could be guaranteed that your wealth would maintain its value over time because nobody else could walk up and claim the gold, silver, or combination of deposits that were there on your behalf. People began using these as currency, and they became wildly popular. So it makes sense then that people eventually thought, why not back the greenback with gold? Considering that there was a gold rush in the country right about this time, it seemed like a good idea. But eventually, of course, that went bust, and we realized we had just limited the size of our currency supply. So here's the advantage of going on a gold standard. People really wanted to have security about the wealth that they had gained from themselves, and basically not have it disappear because of some scheme a banker came up with. They wanted to know that the currency they were using would be stable over time, and you could only really print, cash to back up what you had in the vault. So that seemed to do the trick. But over a couple of decades, we realized you really can't grow your currency to match the growth in the country. And if you guys remember, at the end of the 19th century, this is the Gilded Age. We are growing by leaps and bounds in the second wave of industrialization. And we probably could have benefited from a flexible currency supply at that time. But essentially, that means the people who were wealthy at the beginning of the gold standard were the people who still had the currency at the end. And then there was always the failure threat. If people all decide that there's something wrong with the banking system, they rush in, they grab the gold, and then there's no gold to back up the loans that are out there. So the bank has to close. And we had many panics over the end of the 19th century. Some were incredibly difficult to recover from. So you could see a panic that would take 4 or 5 years for people to recover from. And it was basically every man or woman for themselves. One in particular was incredibly severe, the Panic of 1907. That followed the earthquake and fire in San Francisco of 1906. And we realized right away that if something was a shock to the system, like a fire, an earthquake, a natural disaster, or a man made disaster, then you just lost your banking system as well. San Francisco was the largest city on the West Coast at the time. Los Angeles is incorporated much later. So the idea was you basically had to, reestablish order in the region and rebuild before you could even talk about economics coming back online. So that is why we decided that we needed a backup bank, a banker's bank, in case of emergency. And that's what the Federal Reserve System initially was designed to do. The Fed, as it's known today, is our central bank, and it runs monetary policy and banking practices independently of the US government. That's going to be the focus of our chapter 16. And we're going to talk about the structure and purpose of the Fed in just a very short amount of time. But this is essentially when it comes online. Okay. The Great Depression is, of course, right around the corner from 1913, the first time the Fed opens its doors. And it just becomes an overwhelming crisis that people completely missed all the cues on. They didn't realize that we could be in that situation for a period of 2 decades, thinking classical economics would kick in and the economy would recover. So they sat on the sidelines and really didn't shore up the banking system. So you saw tons of bank failures and people just lost their deposits. That's when we created the FDIC, the Federal Depositors Insurance Corporation, which would guarantee deposits at first up to $2,500 per person. Today, that is up to $250,000 per person in one account. So you have some, protection should the bank get into trouble. Now, guys, if you go out and win the millionaire lottery, win a whole bunch of money or whatever, don't put it all on one account because they only insure up to 250,000. And hey, if that happens, remember Mr. J, would you? Okay. We also decided that a fiat standard, creating a flexible money system probably would be better. We could grow the money supply along with the growth in the economy. So the government selected the U.S. Federal Reserve note at that time as the issued standard of currency. And because of lax regulation up through the Great Depression, you saw intense government control of banking all the way through the 1970s. I remember as a kid having to go to several banks before we could even go to the grocery store or Walmart. You had to go to your savings bank first. It's usually where your check was deposited, and get out enough money that you could then deposit at your commercial bank where your checking account was. You then could write those checks and use that as cash, but it was like a 2 or 3 step process before you could actually make a purchase. In the 1980s, things changed a little bit. And along with Reaganomics came deregulation of the banking system. That meant that all banks could do all things, and it turned into like a one-stop shop kind of process. So you could have a savings account, you could have a checking account, you could even invest in, ventures if you wish to, all at the same building. Deregulation, though, created some problems and opportunities where people caused some abuses to have a larger effect. You used to have banks around that were called savings and loans, and they were designed to build homes for people primarily. They were local entities that were owned by local investors, and they were typically pretty small scale. Well, as part of deregulation in the 80s, they then were able to have loans for businesses. And because they were backed up by the FDIC, they thought, hey, if the loan goes bad, I still get the taxpayer money. So why can it afford to be more risky, right? It's kind of like hedging your bets. And in both situations, the bankers went out. Well, unfortunately, some things began to happen. With those private banks insured by government tax dollars, some very risky loans were made. People knew that banking and business ventures would fail, knowing that they would claim the money, and there were lots of them that were issued because bankers got bonuses with each new one they signed. You had a problem there with interest rates as well, where they expected to get paid back at a high interest rate. But at the time those loans came due, the low interest rates were around, so the profit margins were minimalized. And these guys basically just decided to close their doors and go bankrupt. Well, enough of that happened that the industry was dissolved. Guilty CEOs were prosecuted and sent to jail. And the surviving banks were then heavily re regulated by the FDIC, meaning that we clamped down on the situation. Guys, this was happening when I was in high school in 1987, 1988. We were getting updates every night on the evening news about another banker in a savings and loans crisis who had been prosecuted and was going to jail. That basically cost the taxpayers $124 billion to stabilize that industry and bail them out. And that was, all because of the lax regulation in that industry. So we don't see lots of savings and loans anymore, but it's kind of set up a pattern. Ultimately, we saw the same thing happen in the Great Recession, where banks developed some products that were very, very risky. They said they would make markets safer. They did not. So you got these huge banks failing that really caused an economic crisis. These are documentaries. Inside Job won the 2008 documentary Oscar. So we're going to watch a little excerpt of that in the coming classes. But ultimately, these too big to fail banks, they could tank the entire economy if they got into trouble. So the idea is we came up with a regulatory act that would stop too big to fail. That's known as the Dodd-Frank Act. It was a bipartisan act designed as intense regulation. If banks qualified as too big to fail, then they have these regulations that apply to them. But in 2010, when this came online, it basically started to be weakened by the banking lobby all up until the current day. Unfortunately, the banks that were too big to fail in 2008 have only gotten bigger because they were allowed to buy up some competitors. So this is still a problem that we're dealing with today. How do we regulate the banking system and make sure that these risky ventures don't threaten investors and individuals again in the future? So you'll be hearing more about that in the next presidential election for sure. Today, what we rely on banks to do for us, what modern financial institutions should do, should give us a way to store money. What I mean by that, guys, is they should give us a way to maintain our wealth over time, and banks are not super doing that for us right now. With interest rates as low as they are, I bet you're not even getting a fraction of 1% of a return on the savings accounts you guys have opened up for college and spending in the future. Inflation rises 1 to 2, maybe 3% a year. And that means the longer you keep it in there, the less buying power you have in the future. Now, most of you will draw that out in a very short amount of time, but you can see you're not going to really be able to save your way to becoming a millionaire if inflation is eating up the wealth of what you store in the bank. So I have a criticism of the banking system. They need to be able to create products we can use to save money over the time. And they've been addressing that with new things that are available. Saving money for the future. Obviously, we're at some point going to need, large amounts of cash, and we don't want to keep that here at home or in the car. So that safety and security should be provided. But at some point, you will have to access the loan system and understand what you're getting into as you do. If you need a new car, if you need a new house, ultimately, these are the things that are created so that we can get on with our lives in a way that's feasible and doable. Credit cards have also become $1 billion industry here. So these are the things we expect to walk in the door of the bank and expect our bankers to have ready for us should we need them. Creation of money is a phrase I want you guys to familiarize yourself with, because people automatically assume we're talking about printing currency. That is not the case. So please understand that money creation, how we create money in the banking system, has to do with fractional reserves. A lot of people misassume that when you walk into a bank and you open up a new account, that your money just sits there until you need it in the future. You pay a simple fee, the bank makes a slight little profit or whatever, and that's how it works. But that's totally wrong. The money you're leaving there as a depositor is gathered up with other depositors and made available to debtors as loans. You pay a little You are paid, a little interest on the inside, while when they take those loans and push them out, they charge a higher interest rate when those loans are paid back. So that is what creates essentially the profit for the banking, and it's all about creating more money to loan out. So, in order to understand that, we have to understand the total reserves that are available, whatever deposits come in the front door. They have to be divided by the reserve ratio, which is set by the Federal Reserve. And that's the percentage of deposits that have to stay in the bank versus the percentage of deposits that can be loaned out. If you know that, then you can figure out what the total money supply is. And remember, that's what bankers have the discretion to loan out. So the math goes something like this, and we're going to be using that later on with federal policy. Now, I will review that later, but just know that creating money is not about printing currency. It's what the banker does with your money to make it grow. Okay. In order to understand whenever inflation is becoming a problem with all of this flexible money supply, we have to understand there are two different measures of the money supply. M1 is what we call liquid or spendable assets, and that includes things like coins, currency, and checkable deposits. By the way, your checking accounts are called demand deposit accounts or DDAs. That means that those funds are available for you on demand when you need them. So the idea is there's a couple of different words or names that you might see on the test, but ultimately these things can be spent right now. M2 is all of that plus something we call near monies, which are tied up in timed investments. Near monies, if you try to access them, your access will be restricted and you'll probably have to pay a penalty or a fine because banks have assumed that they will have this cash for a longer time than they would, say, a checkable deposit on demand. So savings accounts, time deposits, CDs, certificates of deposit, money market accounts, those kinds of things have additional restrictions on when you can withdraw them. And they represent future wealth or future currency that'll be accessed when those accounts mature. So we can measure M1, we can measure M2 and figure out where the inflation is happening. And then we can craft better policy at the monetary level. So that's basically it for what you need to know about banking. So the idea is you should have everything now between the video you watched and my notes to be able to move on with your quick checks. So good luck with that, guys, today. I'll be bringing you back next time to talk a little bit more about banking basics and saving and investing. So have a great day. I'll see you back here soon.